This John Lothian News video is sponsored by Independence, Expertise, Execution. What are your 3 points? 3 points communications.
Tell us about the emergence of managed futures mutual funds as an addition to traditional offerings in this space.
What we have seen over the last couple of years is an increase in inflows into managed futures private offerings like ours, looking for very low correlation to traditional assets, as well as high liquidity as far as what managed futures trade, futures contracts that are exchange traded, as well as monthly liquidity. So when you combine that with the next step, which is adding a mutual fund structure to that, it really increases the ability for different investor classes to access managed futures.
What are some of the advantages of the fund structure?
The traditional private offerings, we believe, are always going to be a significant vehicle for the accredited investor who has a high-touch relationship with a financial advisor in a traditional broker-dealer relationship. Where the real advantages of the mutual fund come in are particularly in the RIA channel and the private banking channel, where you can really allocate across a broad group of investors in a very efficient way, and you can make adjustments in a very efficient way, as well as accessing the private client level investor that is below the accredited investor level.
How does one go about setting up a managed futures mutual fund?
The first thing you have to think about is whether or not you want to basically become a mutual fund company, if you're a commodity trading advisor or a commodity pool operator. If you want to go into that business, you need to set up a board, you need to have a board for your fund, you need to have service providers for the fund. We made the decision not to become a mutual fund company, but instead to team up with somebody who has experience in this space. We decided to team up with Equinox Fund Management. Equinox, we chose them because they were the pioneer of the alternative mutual fund structure. They were the first ones to register an alternative mutual fund. And so their responsibility is to actually be the investment advisor on a daily basis, work with the mutual fund board, hire the selling firms, daily performance reporting, the NAV calculations, all of those things that they work on. And the nice thing about it from a CTA's perspective is it allows us to really focus on trading our portfolio.
How might changes in private fund solicitation rules affect Campbell's marketing strategy?
The Jobs Act, as you probably know, relates to private offerings. So when the Congress passed the Jobs Act, it instructed the SEC to change the rules on private offerings to do away with a restriction on general solicitations. What it's likely to mean is easing up the restrictions on what you can say in dealing with investors and the public for a private offering. Now, as far as the mutual fund, the Jobs Act doesn't relate to a mutual fund, but what you see as far as mutual fund marketing and advertising, all mutual fund marketing has to be approved by the fund, and also obviously consistent with FINRA rules where applicable has to be filed and subject to comment by FINRA. So with a mutual fund, you have to just make sure that your marketing is done appropriately and that it receives the appropriate approvals.